In Chapter 4, we're going to be looking at the individual income tax overview, dependents, and filing status. Specifically, we're going to show you the tax formula, the requirements for determining who qualifies as the taxpayer's dependent, and how we determine filing status. So let's get to it. The individual income tax formula, which is really the formula that is followed on the 1040, the Form 1040, which is what our life revolves around. The Form 1040 starts with, and I encourage you to go to our Blackboard folder and download the simulated 1040 that I have. There's no year on it because it is, there's been a lot of changes since last year's tax return. And actually, from those changes, I made my own 1040 because the official 1040 for 2018, reflecting the 2018 tax laws, is not available yet. But this is the basic formula. So in lines 7 through 21, we have gross income. Then in the next few lines, like 23 through 30, I think it is something like that, maybe even more, 34, we have minus deductions for AGI, or adjusted gross income. And once we subtract those deductions, we then get to adjusted gross income. On the second page of the 1040, we then deduct the greater of the standard deduction, which we're going to show you how to determine, or itemized deductions, which we're going to talk about. So we calculate two separate amounts and we compare them, and the greater one is what we deduct. A new deduction is available for qualified business owners. It's called the Deduction for Qualified Business Income. Brand new, never been done before. And once we deduct those deductions from AGI, we then get taxable income. And taxable income we know is our tax base that we determine income tax on. We apply our tax rates to determine the income tax liability. Now you apply the tax rates like you learned in Chapter 1. We'll add other taxes that may be required to be paid. That will equal our total tax. Then we will subtract credits. So there are some tax credits that are made available to people, and any prepayments, payments we've already made to the government for the current year, such as payroll deduction, paying for your federal income tax through your paycheck. And if the amount is positive, once you subtract those two items, you still owe more taxes. If it's negative, we say you've received a tax refund, or you're going to receive a tax refund. So let's look at it a little bit more specifically. So I'm just going to grab my book. I don't have my simulated form in front of me, of course, but we'll muddle through. And if you do have the simulated form in front of you, I encourage you to look at it. If you don't, please turn to page 4-3 of your book. Now, on page 4-3 is a 1040, so we want you to be looking at this form, getting a little familiar with it. And in the beginning, you could see you got to give some pertinent information about your name, your address, your social security number, your filing status, which we're going to show you how to determine today. Exemptions, so who are your dependents, taxpayer. And then we start with income, and income is reported on line 7 through 21. Now, we're going to get into a couple chapters talking about income, but here's what you have to remember. U.S. tax law is an all-inclusive income concept. What it means is that all income should be included on your tax return unless there's somewhere in the law that specifically excludes it. Okay? Furthermore, it's realized income. Income you received or it's available to you. Okay? All realized income included in income unless it's specifically excluded. It's recognized on the tax return. Some of the common things: wages, interest, some dividends, alimony sometimes, business income of your sole proprietorship or single member limited liability company, something called capital gains we're going to talk about in a few minutes, or losses, IRA distributions, pensions and annuity income, rental income, farm income, unemployment compensation, certain parts of your Social Security benefits received. And then there's the all-inclusive other income. That if there's not a specific line, doesn't mean it's not included. You just put it on line 21. Certain items are specifically excluded. So this is income that's never included in taxable income and is taxed. Never. Certain things like municipal bond interest. So if you own the bond of a municipality and you receive interest income, and municipalities include state, local, county, school district, governments. You purchase a bond from them and you are receiving interest income. That is never taxable. It's interest free. Or I'm sorry, tax-free interest income. The gain on the sale of a personal residence, and you'll see there's lots of things that are excluded from income. We're just bringing out one or two. There's also deferred income items, meaning they're income and they're going to be taxed, but they're just not being taxed right now. They'll be taxed later. And a classic example of this is something called an installment sale. In an installment sale, you may have sold something to someone, but you're not going to receive all the cash today. You're going to receive it at different points in the future, maybe over years. An installment sale says this: you might have sold that item this year, but we're not going to tax you on the gain on that until you start receiving the cash from the sale. So it doesn't mean you never pay income taxes, it's just deferring the income tax until you receive the cash. We'll be talking about those items. The character of income or loss is very important because it will determine what kind of tax is calculated on it. So we have tax exempt, no tax. We have tax deferred, there's no tax in the current year. Ordinary income, and most items are ordinary. Ordinary rates are applied to determine tax, and you use the ones in the tax rate schedule. Certain gains and losses, called capital gains and losses, we'll talk about in a second, are taxed at special rates, as well as these things called qualified dividends. We have a chapter on this type of information, not only dividends, but interest. And we're going to be talking about what makes an item a qualified dividend. And it's basically a dividend a shareholder receives from a United States corporation. Those dividends aren't taxed at your normal tax rates. They're taxed at lower rates. Also, certain capital gains are taxed at lower tax rates. Now, you will have a capital gain or a capital loss on selling a capital asset. A capital asset is not defined in the tax code. It is defined by exception. What does that mean? And this is on page 4-6 of your book. It tells us what a capital asset is not. A capital asset is not an accounts receivable, it's not inventory, and it's not an asset used in your business. So if your asset qualifies as one of those three, it's not a capital asset. If it doesn't, then it is. Some common examples of capital assets are personal assets you use, investment assets such as stocks and bonds. That's number one. The next thing we determine is, did I sell it for a gain or a loss? How the heck do I calculate that? Well, when you sell something, the IRS does not look and go, oh, you sold something, you got $10,000 cash, we have to tax all $10,000. No. They apply what's called a return of capital concept. And here's what that means. They basically say, well, what do you have put into this asset? How much did you buy it for? What kind of improvements did you make? Add those together. Did you subtract any depreciation from it? If you did, you subtract it. And we say, that's what you put into this asset. We call that adjusted basis. And we subtract that from the selling price. So if you sell your stock in Facebook for $20,000, selling price $20,000. If you originally bought that same stock for $12,000, then the first $12,000 of that $20,000 isn't taxed. It's a return of your original investment, your return of capital. So it's only the excess that would be taxed as a gain or subtracted as a loss. So that's number one. Second thing, it's only long-term capital gains that have this preferential tax rate treatment. What's a long-term capital gain? It's a gain on a capital asset where you hold the asset for more than 1 year. So you own it for more than 1 year. If you own it for 1 year or less, it's considered a short-term capital gain and it's taxed at ordinary rates. What are the preferential rates? They're the same as qualified dividends. They could be taxed at 0, I think 15% or 20%, depending on what your ordinary tax rate is. So we'll be coming back to that, but just to introduce you to that concept. Again, there's what capital assets are not. The preferential tax rates. And another thing to keep in mind is if you sell stuff, capital assets, for a loss, you cannot deduct all the loss in a year. If it's more than $3,000, you can deduct only up to $3,000 in a year. The rest is carry forward and you could take it as a capital loss the following year. We'll be talking about that again. Once we determine the amount on line 23 of your 1040, then we will be able to start deductions to get to adjusted gross income. And they're in lines 23 through 34 actually. Line 35, that's on page 4-3, no longer exists. That was taken out by the tax law. So student loan interest may be deductible. If you pay money into an IRA, it may be deductible. If you pay alimony before a certain date, it may be deductible. And there's other items there. Another item that has basically gone away for everyone but the military is line 26, moving expenses. Okay, that was a much broader audience that had the ability to take that deduction. Not anymore. So these are some examples of items that would qualify. There's not a lot of them, but if you can get any, you take them. Because that leads you, once you subtract those, to a very important number called adjusted gross income. Adjusted gross income is very important because it is used to calculate certain tax deductions and tax credits. So you want that number as low as you legally can get it. From there, now we're on page 2 of the 1040, we deduct deductions from adjusted gross income. The first one is the greater of the standard deduction or itemized deductions. Now, itemized deductions we have an entire chapter on, but the most common itemized deductions are personal expenses that you pay for medical, state and local taxes to a certain extent, mortgage interest, and charitable contributions. If you add up those 4 items and they are more than a standard deduction, which we're going to define, you subtract your itemized deduction amount. If they are less, you subtract your standard deduction amount. And that's usually on line 40 as of right now. Then we subtract line 42, which is called deduction for qualified business income. Now, if you're looking on page 4-4, it says exemptions. That's gone. That's replaced with deduction for qualified business income. And that's a separate deduction than the standard or itemized, the greater of those two. So first we look and say which is greater, standard deduction or itemized deduction? We deduct that. Then we say, do we have this thing called qualified business income? And that's a limited scope of individuals. These are sole proprietorships, partners and partnerships, shareholders in S corporations, and members of limited liability companies. What they basically say, and we're going to talk more about this when we talk about those individuals, is how much business income did I have from my business? 20% of it I could deduct and not get taxed on. And that leads us to our taxable income. Now remember, we're talking about standard deduction. Okay, for 2018, we have our dollar amounts. Remember we said we compare your standard deduction to your itemized deduction. Well, the amount of your standard deduction is based on your filing status. So if you are married filing jointly, you have a $24,000 standard deduction in 2018. So if those personal expenses, medical, state and local income taxes, charitable contributions, and home mortgage interest, if you're married filing joint and your itemized deductions are more than $24,000, you subtract your itemized deductions. If they're less, you subtract the standard deduction. If you're a head of household status, it's $18,000, and if you're single, it's $12,000. But there's other items that can be involved here. So these are just general amounts, just to introduce you to this concept of standard deduction. Remember, we use our tax rate schedules because we have a progressive tax system to calculate our tax, and not forgetting that some of our items may be taxed at lower rates than normal. There may be additional taxes that need to be paid, such as self-employment taxes. We talked about those already. Alternative minimum tax, which we'll talk about in a future chapter. Once we determine our income tax and any additional tax we may have to pay, we then subtract our tax credits. Tax credits are a dollar for dollar reduction in tax we owe. And there's a whole bunch of them, and they're listed on the back of your 1040. There's the child tax credit. There's now a family tax credit. There is the child and dependency care credit. I think the adoption credit is still around. There's education credits for people going to college. And there's some business credits, a foreign tax credit. So like I said, we have a whole chapter on them. But know that when you have a tax credit, you're actually reducing your liability, that tax liability you just computed, dollar for dollar. And then finally, we subtract any prepayments we made, whether it be taxes we paid from our wages, so our employer took them out, sent them off to the government. If we made any additional estimated payments during the year to cover our taxes. And sometimes if we overpay taxes from the prior year, instead of taking a refund, we just say, apply them to next year's taxes. So all those items are subtracted, and if it's positive, you still owe money, and if it's negative, you'll get a refund. Okay, so that's the backside of our 1040. That's how we determine our taxes. So that's the 1040, one more time. And that's a great little exhibit 4-1. You always want to keep that in mind. That's what we're doing here. So tax formula is done. Now let's start talking about a dependent. Dependents were a really big deal before 2018. Because you were able to take a deduction for each dependent you claimed on your tax return. But as of 2018, that's gone away. Why is it important, though, to still determine your dependents? It will help you to determine your filing status. It may, or it may also help you determining if you're eligible for tax credits, such as the child tax credit or the American Opportunity Credit. So we still go through the exercise of determining who is a dependent for a taxpayer. Now, there are two rules that are common among the two separate tests for dependents. There's tests to determine if someone is a qualifying child dependent, which if you can get somebody to be your qualifying child dependent legally, that's the status you want them in. If they don't qualify as your qualifying child, then you look to see if they are considered and meet the test of a qualifying relative. The two tests that are common between the two is the potential dependent is a citizen of the United States or a resident of the U.S., Mexico, or Canada. So you don't have to be a citizen, but you have to reside in the U.S., Canada, or Mexico. The other test is that if the potential dependent is married, they cannot file a joint tax return with their spouse. If the only reason they filed a joint tax return with their spouse is to get a refund of all of their money, meaning they would have no tax liability, they have none, then they do not fail this test. Let's give you an example. Dad has a daughter who's 17. She's married. Okay. Child meets all of the qualifying child tests. But dad comes to this and says, my kid's married. Now he has to look and see, did my child file a tax return with her husband? Well, if she doesn't file a tax return at all, she meets the test. What if she files a tax return with her husband because they both have jobs? Well, if when they file their tax return, the only reason they file it is to get all the money back that they paid in. So that means their tax liability is zero. They owe no tax. They still meet the test. If the daughter and her husband file a tax return and they have $3 of tax liability, she just flunked the test. She cannot be dad's dependent, qualifying child, or qualifying relative. In order to be a dependent of a taxpayer, all tests must be met. So although this isn't a common situation, it is present, and we want to make sure that it's being passed correctly. Now, what makes a potential dependent a qualifying child? They meet 4 more tests. They meet a relationship test to the taxpayer, an age test, a residence test, and a support test. Relationship. This is a very narrow relationship. It is the taxpayers. The potential dependent is the taxpayer's son or daughter, stepchild, stepchild, foster child, brother, sister, or half brother, half sister, stepbrother, stepsister, or a descendant of any of those relatives. So it could be a niece or a nephew, a grandchild, grandson, granddaughter. But that's it. And furthermore, if it's a brother-sister relationship, the taxpayer must be older than the dependent. The only time the brother-sister relationship, the taxpayer can be younger, is if the potential dependent is totally disabled. Age test. The child must be younger than the individual claiming the child as a qualifying child, and that's what I was just talking about. And the potential dependent is under 19 at the end of the year. They can't be 19 during the year. They have to be under the age of 19. That's the only test there. If they're under age 19, they meet the age test. What if they're 19? Well, if they're under 24 at the end of the school year and a full-time student for 5 months of the year, they meet the test. So if they're under 24, over 19, but under 24, they have to be a full-time student for 5 months of the year. They meet the test. Taxpayer may be able to claim them. Or if the potential dependent is permanently and totally disabled, it doesn't matter how old they are. They meet the test. Residence test. The potential dependent must have the same residence as the taxpayer for more than half the year. Now, temporary absences are okay, such as education, military, hospital, vacations, and custody. Okay, so those items don't impact residency tests. Support test, and this is important because we're going to see there's a support test for a qualifying relative, but it's different. In the qualifying child, the child must not provide more than half of their own support. If the child provides more than half of their own support, taxpayer cannot claim that person as a dependent. Scholarships are not included in this computation. So what is? Page 4-13. Food, toiletries, school lunches, clothing, recreation, medical and dental care, child care, allowances and gifts, wedding costs, lodging, education. Okay, these things are all looked at together and we say, did the child pay for more than half of these? If they didn't, then they meet the test. So 6 tests to be a qualifying child. U.S. citizen or resident of U.S., Mexico, or Canada. If they are married, they don't file a joint return with their spouse, or if the only reason they do is to get a full refund of all their money, that's okay. We have the relationship test, age test, residency test, and support test. If the potential dependent meets all the tests for a taxpayer, the taxpayer claims them as a qualifying child. Now, what if they don't meet them? Before we go to qualifying relative, I forgot we got some tie-breaking rules. Sometimes two parents will be able to claim the same child as a qualifying child. Well, they can't split them in half. Okay, so they have to go under tie-breaking rules. If more than one person can claim a potential dependent as a qualifying child, the parent gets the dependent qualifying child first. If it's two parents, the one the child lives longer with. Okay. If it's neither parent, the one with the higher AGI. Rodney and Anita have two children. Braxton's 12, lives at home, and Tara's 21. She's a full-time student and does not live at home. While Tara earned $9,000 in her summer job, she did not provide more than half of her own support during the year. Are Braxton and Tara qualifying children of Rodney and Anita? Let's look at Braxton. We assume he's a U.S. citizen and he's not married, right? They don't tell us otherwise, so that's the assumption. He's their son, so he meets the relationship test. He's under 19. It doesn't matter if he's in school or not, just as long as he's under 19. He lives at the home the entire year, and he does not provide more than half of his own support. So he provides less than half of his support. He is their dependent qualifying child. Let's look at Tara. Tara's their daughter. She's less than 24 and a full-time student. Does she live with her parents? Yes, because the assumption is she's temporary absent from home because of school, and that's okay. And her parents provide more than half of her support. We don't count her scholarship, so she does not provide more than half of her own support, so she's also their qualifying child on their tax return. Braxton's uncle Sean, Rodney's brother, lived in the Hall's home, the same home Braxton lived in, the 12-year-old, for more than 11 months during the year. Can Sean claim Braxton as a qualifying child? Watch this. Does he meet the relationship test? Yes. He's the son of Sean's brother. So remember, your niece and nephew qualify under the relationship test. Is Braxton less than 19? Yep. Do they live in the same house for more than half the year? Yep. Does Braxton provide more than half of his own support? No. So Sean here can claim Braxton as a qualifying child. He won't, because Rodney and Anita are first tie-breaking rule. So Rodney and Anita are allowed to claim Braxton as a dependent because they are his parents. But that's how the tie-breaking rules go. So just because one person can claim a child as a qualifying child doesn't mean other people can either. And the tie-breaking rules decide who ultimately gets to claim the child. Now, what if the person is not a qualifying child? Well, you don't lose the dependent. They may be a qualifying relative. So somebody who does not qualify as your qualifying child dependent may qualify as a qualifying relative dependent. There's less tests here. Still have to meet the citizenship test and the married filing joint test. Those first two tests we talked about before. In addition, you have to meet a relationship test, which is a much broader definition of relationship, support test, and a gross income test. Let's take a look. The relationship test. This is much broader. It's just about any relationship except for your cousin and your best friend. And even those two can still be considered under this test. They're a descendant or ancestor of the taxpayer, so now it's a child, grandchild, parents involved here, grandparent. They're the sibling, a son or daughter of the sibling, but not cousins. A sibling of the taxpayer's mother or father, so now you're getting into aunts and uncles. An in-law, mother-in-law, father-in-law, sister-in-law, brother-in-law. If they're not meeting that kind of close relationship test, either blood or through marriage, they could still meet the relationship test because they're a member of the taxpayer's household for the entire year. So your son's girlfriend lives in your home the entire year. they meet this test for you to claim them as a qualifying relative dependent. Your cousin lives in the home the entire year. Support test. The taxpayer, this is different than what we talked about before. Before it was the child cannot provide more than half of their own support. Well, now the taxpayer must pay more than half of the support of the potential qualifying relative dependent. And the gross income test. The potential dependent's taxable gross income, so the amount that would be on their tax return on line 23, is less than $4,150 in 2018. Equal to or less than, they flunked the test. I'm sorry, or more than. Equal to or more than, they flunked the test. Less than, they meet the test. Now remember, I didn't say all income. I said the income they receive that would be considered in gross income on their tax return. For example, John is a 22-year-old student who has lived in the dorms for most of the year, but spends the rest of the year living with his parents. He earned a $5,000 scholarship for the school year and has worked hard to support himself through school, earning $6,000 to pay for his own expenses. His parents have supported him by paying $7,000 for food, clothing, and lodging. Are John's parents able to claim him as a dependent? Well, is he a qualifying child? Relationship test, yes. Age test, yes, he's less than 24 and a full-time student. Residence, he lives at his parents' residence except he lives at school. Support test, yes, he doesn't provide more than half of his own support. Gross income doesn't matter for a qualifying child. So he is a qualifying child, but let's say he wasn't. Would he be a qualifying relative? Well, the only three tests we have to look at here is, does he meet the relationship? Yes, he's their child. Does he provide, does the taxpayer, the parents, provide more than half of his support? Yes, they provide $7,000, he provides $6,000. That scholarship is not included in the computation. Does he meet the gross income test? No. He makes $7,000 or $8,000 in wages during the year. That's all taxable. So his gross income is more than $4,150. So he would not be considered a qualifying relative, but he is a qualifying child. Okay, so take a look through all of those examples in your book. There's some great examples, and really keep all the rules separated. Remember, we have qualifying child, qualifying relative. Okay, so once you determine that, now you're going to look at filing status. There's 5 different filing statuses to choose from. A taxpayer can choose to be married filing jointly, married filing separately, and basically those are the only 2 for married people. Qualifying widow or widower, single, and head of household. Married filing jointly, your marriage status is determined on the last day of the year. Are you legally married on the last day of the year? If the answer is yes, you've been married the entire year. If one spouse dies, the surviving spouse is still considered to be married for the entire year, unless they remarry before the end of that year. Okay? One thing to remember is that when you file your tax return married filing jointly, 2 people go on the tax return, and the only 2 people who could ever go on a tax return are the 2 spouses. Can't put your kids on the tax return. It's the 2 spouses. And same-sex marriages qualify here as long as they're legal in the state that you're from or you were married in. It's considered a legal marriage, union. Okay, that's the best filing status too for married individuals. Another is married filing separately. Taxpayers are married but file separate tax returns. There's not a lot of tax benefits. Usually if somebody asks me to file a tax return separately, I show them what happens if we do. And usually there's non-tax reasons for it because the 2 spouses are responsible and liable for what's on their own tax returns. So if you're a little sketchy about your spouse, you may not want to file a joint tax return with them. All right. A qualifying widow or widower is a status available to people who are widows or widowers, and it's available after the year of death of the spouse. To qualify, you can't remarry, and you must maintain a household for a dependent child. not a dependent relative, a dependent child for those 2 years. So what's the great thing about being in the status? You still pay your taxes like you're married filing jointly. So more of your income is taxed at lower rates than it would be under single status. Single is the worst status. This is the unmarried. You're not married and you don't qualify for anything else. You're single. So you pay the most taxes on the income compared to other statuses. Finally, head of household. This is available to the unmarried or considered unmarried at the end of the year. So if you're saying I'm going through a divorce, I'm unmarried. No, you're still married. You're filing married filing separately or married filing jointly. You can't create your own status. There is a little reprieve there. If you are going through a divorce, let's say, and you're considered an abandoned spouse, and abandoned spouse is on page 4-23. You're married at the end of the year. You don't file a tax return with your spouse. Your spouse hasn't lived in the home for more than half of the year. And the last 6 months of the year. You lived apart for the last 6 months of the year, continuously. So from July 1st through December 31st, spouse has been gone, not in the house, never. And you have a child who's lived in the house for more than half the year, a dependent child. Okay? Then you don't have to file married filing separately. You can choose head of household status. You're considered an abandoned spouse. You have to pay more than half the cost of keeping up a house, and you lived in a taxpayer's home with a qualifying person for more than half of the year. Qualifying person is a qualifying child or qualifying relative. The only person who could live outside of the taxpayer's home is their parents, but the parents must be qualifying relatives. And there it is again. So you may be able to do head of household status if you are married, if you fall into this abandoned spouse rule. You're still married. You're not legally separated. At the end of the year, you don't file a joint tax return with your spouse. They haven't lived in the house for the last 6 months of the year permanently. And you pay more than half the cost of maintaining the home for a dependent child. Dependent child. Qualifying person for head of household status. So you don't need a qualifying child for head of household status. You need a qualifying person. A qualifying person is a qualifying child dependent or a qualifying relative who is taxpayer's mother or father. The parents do not need to live with the taxpayer. Taxpayer must pay more than half the cost of maintaining a separate household, and the parent must qualify as the taxpayer's dependent. If you are a qualifying relative who is not the taxpayer's parent, then you must live with the taxpayer for more than half the year. They must qualify as the taxpayer's dependent in order for the taxpayer to claim head of household, and must be related to the taxpayer through family relations. If the dependent only met the qualifying relative dependent test because they lived in the taxpayer's home for more than half the year, it's not a qualified family relation, then they are not considered your dependent for purposes of head of household. You would not qualify for head of household status. So you really need to look at these rules, and there's some great flow charts at the end of your chapter. So page 4-27 takes a look at qualifying child and qualifying relative flow chart. It goes into 428. On 429 is the head of household flow chart. and filing status overall is on page 4-30. So really look at the examples and these flow charts and really get used to the rules. Assume last year Rodney passed away, and during the year Anita did not remarry but maintained a household for Braxton and Tara, her dependent children. What would Anita's filing status be? Well, last year she would have been married filing joint with Rodney even though he passed away. And it doesn't matter when he passed away during the year. In the year of death, you're still allowed to do married filing jointly. But after the year of death, now we've got to look and see what status does she qualify for. And she qualifies for qualifying widow or widower because she did not get remarried. The reason she's single is from the death of her spouse. She's a qualifying widow. She maintains a home for a qualifying child, at least one. Assume Rodney and Anita divorced last year instead. During the current year, Braxton, her son, lives with Anita. Anita pays all the costs of maintaining the household for herself and Braxton. What's her filing status this year? Head of household. Why? She's unmarried. She maintains the household for a qualifying person, her qualifying child, for more than half the year. Head of household. Assume Sean, remember Sean, Rodney's brother, lived with the Halls, but Sean paid more than half the cost of maintaining a separate apartment that is the principal residence of his mother, Sharon, whose gross income is $1,500. Because Sean provided more than half of Sharon's support during the year, and because Sharon's gross income was only $1,500, she qualifies as Sean's dependent, qualifying relative. What is Sean's filing status? Head of household. Normally it's single, he's unmarried, but he maintains the household for a parent. A parent does not have to live with you. Okay? A parent could be a qualifying relative without living with you. A qualifying relative test does not consider abode. Remember what it considers: relationship, gross income, and support. Sean here has is related by blood. He provides more than half the support of his mother, and his mother's income is less than $4,150 for the year. So the mother is Sean's dependent. Parents don't have to live with a taxpayer to be to qualify the taxpayer as head of household. As long as they're maintaining the household and paid more than half the support for the separate household. The qualifying relative is a qualifying person. It's his mother, and he's unmarried. He's met head of household. This is how you have to be careful with the rules. So that ends our discussion of Chapter 4. Now, we didn't talk about standard deduction. I'm going to do a separate illustration quickly for you to see how we determine the standard deduction, the additional standard deduction, and a special computation for standard deduction. So look for that.